Hi class, let's take a look at chapter 12. This kind of marks the end of fixed income analysis and kind of represents almost the beginning of equity analysis. I know economic and industry analysis plays a role in the fixed income securities, but we seem to talk about it a little bit more with equity. So first off, I think it's good to start off with industry analysis. And in business, when we're analyzing like investment opportunities, if we're analyzing companies in terms of stock returns, if we're analyzing credit, whether or not we want to like give a company a loan or trade credit or something. A lot of times, all the financial information has to be compared to other companies. And instead of just comparing it to like maybe companies in the same city or the same state or the same country, usually we compare a company to companies in the same industry. Because the thought process is that within industries, the profitability should be pretty similar. The riskiness and the variability of profits and thus how much debt companies use, they all should be pretty familiar. So then it's kind of like, the old saying, comparing apples with apples. And so when we do a lot of analysis of companies and how they're doing and how companies do compared to the overall economy, we always talk about industries. And so that's kind of the beginning of this economic analysis, really. A couple things we need to understand. First off, how do we decide what industries are, right? What are their titles and how do we identify them? And a lot of this actually comes from the government. And so I think one of the first systems we had was something called the SIC code, Standard Industry Classification Code. And that's still something that we use. In fact, it's in a lot of the financial databases. I use it all the time. When I want to calculate how a company's financial ratios are, I do that in comparison to other companies in the same SIC code. If I want to look at companies that are tech companies, there are certain SIC codes I'll pick out and will define as tech companies. All the other ones are like industrial companies or some other type of industry. And there's some other ones, the North American Industry Classification, that was supposedly kind of an improvement upon SIC, but I still see SIC being used a lot. And the last one was something that was done by I think it was the financial industry, the GICS, the GICS. That was another one, and some of these, they're just slight modifications. And where I've really found this lately was with a few companies, tech companies, right? I think it was with maybe with Facebook and maybe Google. In fact, let me look it up. Let's look it up right now, because some companies we would think as tech companies. But you know what? Sometimes they get placed in industries like advertising and consumer products when we think in them as tech companies. So give me a second. I'm going to pull up another website. Just bear with me for a second. This is called FINViz, and it will show us companies in different industries. It's FINViz.com. And so I'm going to click on this thing right here, and you can go check out this website yourself. This is the name of the website right here, FINViz. And I think the really cool thing that they have is this it's called a heat map, and you can look at the stock market kind of visually. All right, and so up here we can list different companies, and usually it's by indexes, right? And so, S&P 500, that's the Standard & Poor's 500, right? The Dow Jones Industrial Average, the NASDAQ 100 is just obviously about the 100 biggest companies listed on the NASDAQ exchange. S&P 500 is across any exchange, right? Dow Jones is across any exchange, but it's really the old one, and it has a weird way, if you remember from like chapter, was it 3, of calculating the average. It's kind of the price-weighted method, which is kind of weird. Sorry about that. I think running my computer's having a hard time. Russell 2000 is like it's like all the small companies, small to medium-sized companies, all stocks. Okay, so what I wanted to show you here, look, here's tech, right? Microsoft, Oracle, Palantir, right? Semiconductors, NVIDIA, Broadcom, right? And then consumer electronics, right? This is the same place you might find like Sony, right? Consumer cyclical, Amazon. Communications, Google and Meta. So why is that kind of interesting? Well, because let me pull up ETFs over here on the left-hand side. If you buy let's say you want to buy tech stocks, you may buy an ETF for tech stocks, and that ETF might not even have stocks like Google or Facebook, because they're considered communication stock by their industry classification. And so that's just an example of sometimes you got to check, So like here, do you see this part right here, U.S. sector? So here's tech stocks, and you can see the different ways. Here's Vanguard Information Technology, which I have to double check. I think it may not include. I don't know if it's Facebook or something like that. Let's see, financials, right? These are some of the industry classifications: consumer cyclical, energy, real estate, industrials. And so you can see here, it's not all of them, but this is kind of like they've kind of broken it down into a system that works for this source. It depends on where they're getting their data. I'm not sure where they're getting their data. All right, some of the uses for using industries is one is a business cycle sensitivity, right? Because we know that the economy goes through ups and downs, right? It goes through the business cycle of expansion, a peak, contraction, a trough or bottoming out, and then another expansion. So that process just keeps on going, right? It turns out that some industries do better than other industries during different phases of the business cycle. And so we'll talk about that. Industry life cycle basically means if you look at companies in industry, they will often follow a certain life cycle, right? You look at the life cycle of a butterfly, right? It goes through these different life cycles, right? We see that with industries where they start out, like a pupa, a little small larvae or something, and then they kind of they grow, and then they kind of go into a cocoon, and then they blossom and they start to grow really big. And so we're going to look at that, and that's one way to analyze an industry, is to kind of see where it falls along that classic curve of what industries follow in terms of their life cycle, right? So if a company looks like they're toward the end of the industry life cycle, well, maybe you have to take that into account when you invest in them. And then we'll look at strategic analysis, and you may have learned this in kind of like Porter's 5 forces type thing. And we can use that to judge a company's strategy. And for ourselves, we can say, do we agree with it, right? Because if it isn't appropriate based on the industry that the company's in, then maybe we don't want to invest in them. Here's an example of some of the different key industries. Basic materials and processing, like building materials, chemicals, wood, roofing, paper, mining, that kind of stuff. Discretionary for consumers. And by discretionary, I mean it's not something that you have to buy all the time. In other words, you only buy it when things are going well. Cars. I know it seems like, well, I have to have a car, I have to get to work, right? But we do see cars, kind of like when you go into recession, car sales really drop. And so people hold on to their cars longer, or they'll buy used cars. But the sale of cars in the new car industry definitely gets hurt, and it's cyclical. Clothing. So, people tend to wear their clothes longer, maybe not buy new clothes when we go into recession. Hotels and restaurants. Maybe these are the types of restaurants where, it's kind of a splurge. You don't have to go there. I realize nowadays, I think, when the economy's not doing well, a lot of people, depending on your job and situation, you still go out, but maybe instead of going to a really nice place, you go to, maybe people are hitting places, like In-N-Out or McDonald's, some more economical meals, right? And maybe that doesn't fall into this category, but traditionally, restaurants are kind of thought in this consumer discretionary. And they're highly cyclical. These industries, they go up and down with the economy. All right. The stock does really well when the economy's doing really well, and the stock does really poorly when the economy's doing really poorly. So we try to identify, right, certain industries that kind of behave like this. And this one's consumer discretionary, and we can kind of look at that when we look at sector rotation models coming up here. Consumer staples. These are things that consumers have to buy no matter what. Right, so people are going to buy food and beverages. Maybe not, they don't have to buy beverages, but maybe water from the spigot. Personal care products, paper towels, baby diapers, all that kind of stuff. Energy. Anything related to the production and the creation of energy. Financial services, banking, finance, loans, insurance, even real estate gets lumped in there just because real estate usually takes on a lot of debt. And so it's very finance sensitive. Healthcare, so this is like your drugs, your medical equipment, hospitals, health insurance. Industrial producer durables. So these are things that companies buy so that they can make stuff, right? Heavy equipment, machinery, that kind of stuff. And then technology, computers, software tech consulting. In fact, I should probably, instead of telecommunications, I should probably call this communications, cell phone, wireless, ad spending, that type of stuff. And then utilities, electric, gas, and water, that type of stuff. So that's just a rough breakdown. So let's take a look at these, and we'll take a little quiz here. So natural gas exporter or transporter, what industry would that be in? That would be energy, right? How about construction equipment like Caterpillar and John Deere, all those pieces of equipment that you see? Let's take a look here. It looks like it's going to be industrial producer durables. So we put that under industrial. Cell phone company. Communications, right? Like Verizon or something like that. Semiconductors, so that would be technology, right? Wastewater services. The key here is regulated, and anything regulated is usually going to be put into utilities. Safeway, the supermarket. That's usually consumer staples. So those are things, people buy all the time. And why is it separated from discretionary? Because if the economy goes into a recession, people still buy consumer staples. And I'm not talking about Staples, the office supply store. I'm not talking about, Staples to combine two sheets of paper. I'm not sure exactly the history of that word, where it came from, but it's things that people buy no matter what, kind of things like, milk and eggs and cereal, bread, rice, chicken, whatever. Soap and detergents. That would go under consumer staples again. Maybe people use a little less soap when the times are tough. But traditionally, Procter and Gamble, that type of stuff, that's all consumer staples. Luxury leather goods, consumer discretionary. Unless you just have to have your whatever Gucci, Versace bag or something like that. But anyway, that would be consumer discretionary. All right, let's talk about the business cycle in a little bit more detail. Kind of a broad way we define these are cyclical industries and non-cyclical industries. The next slide after this, we're going to break that up into a little finer detail, but this is just a broad way of looking at how companies are sensitive to when we go into recession or when the economy starts picking up. So cyclical industries, they do better when the economy does really well. So they outperform during expansions, we call it, but they underperform when there's a recession. And so think of something like, the casinos, Las Vegas. When people are flush with money, they're doing well, they go gamble more. When there's a recession, they stop gambling. Or like when I was talking about the Ford or GM, the car companies, right? They sell more cars during good economic times. So those are examples of cyclical industries, because on the flip side, when the economy goes down in recession, they do less well. Examples of these are like consumer discretionary, also industrial products. And we typically would expect these companies to have higher betas. If you remember from Finance 300, and beta is basically kind of how a stock is correlated with the overall market. And so when a company has a high beta, it means if the stock market goes up 10%, a company with a high beta might go up 15%. And when the stock market goes down 10%, this stock might go down 15%. So it does a lot better, but then it also does a lot worse. So in a way, you could say it's riskier, right? And then we have non-cyclical, and sometimes these are called defensive industries because they're less sensitive to the business cycle. They're not doing this all the time. They're a little more steady. And so what that means is when the economy is doing really well, they're not going to do as well as other companies because they're more steady. But when you go into recession, then these companies are going to look a lot better than those other risky companies. Examples of this would be like healthcare, right? Because during recession, people still get sick. During expansion, people are getting sick. So, healthcare doesn't necessarily fluctuate that much. Consumer staples, people still have to buy food, right? We don't see utilities, changing. You'd think they would a little, but not that much, And so here we'd expect lower betas, right? Because if the economy goes up, S&P 500 goes up 10%, utility stocks and stuff like that might only go up 5%. And then when the economy or S&P 500 goes down 10%, well, these same stocks may only go down a little. And there was a couple stocks that you might add in here, like Walmart, McDonald's, the fast food burgers, because because people tend to go to those places even when we go into recession. So I know McDonald's is considered a restaurant, and that's more consumer discretionary. But there are kind of unique companies that kind of maybe don't fit that industry mold sometimes. This is a sector rotation model. And what it tries to show you is how the economy keeps going through the business cycle, right? Expansion, peak, contraction, bottom out, trough, and then expansion again. And at different parts of this economic business cycle, different industries are good to invest in. And that's what this tries to show you. And you can look up, you can just go ahead and look up different ones and you'll see them. There are a bunch of them all over, on the internet. And this is just one that I saw. I think your textbook has another. But think about like this is the business cycle, right? Right. And so this would be like, GDP, how the economy's doing, that type of thing, right? And this would be time, right? So we see the economies, there's an expansion where things are going better, GDP growth and all that, right? That's this right here, expansion, right? And then we'll usually hit some type of I don't know, a peak where the market kind of like tops out. And so maybe that's like um, let's say it's right around here. And then we'll go into a contraction and the economy will start to go down. And that's right around here. Okay. And then finally we kind of bottom out and the economy starts maybe doing a little bit better. And so we'll call that the trough, like a feeding trough, a bowl in the bottom of the ground. Okay? And that would be kind of down here. Okay? And the idea is you just keep going through this cycle up and down like a roller coaster, and you kind of keep going around this circle. Okay? And so we just keep going through this again and again and again. And so some people try to predict where we're going in the economy, and then they'll move their money into different industries. Okay, so like if they think that we've reached the peak, if they think that's what's happening, right, they're going to get out of energy and industrials and start moving into communications and healthcare. And I would say maybe not advertising communications, but more like cell phone stocks, that type of thing. The idea here is when the economy's peaked, now we're going to go into a contraction, right? Things are going to get smaller, so we want to be in non-cyclical businesses. And that's why you start seeing here the road as the market goes down you see healthcare, staples, right? Utilities, because the economy is going down here, and we want to be in businesses that are less sensitive, so they won't go down as much. Our investments, okay, and so that's this part right here of this curve going down. And then the idea is, somewhere along this trough, we actually start to see financial stocks do well. And we'll get into this a little bit more, but part of the reason is financial stocks start doing well is because the government starts lowering interest rates. And for financial companies, when their cost of money that they get their money from, like the government and stuff, the interest rate goes down. But they have outstanding loans that they're charging people, right? It's kind of like, so their spread on interest rates goes up. They become more profitable because they're not paying anything for money, but they're still charging people for money. It's kind of like, this is a little different, but how like interest rates started going up, but our checking and savings accounts were still like at 0%. And so they kind of like take advantage of, depending on the direction, things going up and down. And here, their cost of money, as it is from the Fed, how the Federal Reserve sets interest rates, their short-term cost of money goes down. And so they start becoming more profitable. And then we start seeing tech companies starting to turn around. This is down here in the trough. And then the economy starts to pick up here, right? And when the economy picks up, we start seeing discretionary. People start buying stuff that they've been putting off during the recession. Companies start having to make stuff, so they have to start buying more materials. And then companies are making more stuff, so they have to start buying like industrial equipment. And then we start seeing energy prices going up. And usually right toward the end of that expansion, we often see energy prices at a peak. And then people are looking at, okay, where are we going next? And they start thinking, oh, the economy is going to go down, and it starts all over again. one thing I want to show you right now. Let's just take a look at that FinViz site again. Bear with me for a second. It was really slowing down my computer. Hopefully it'll be okay. Let's see here. Because what we can do is we can look at how different industries have been doing return-wise, and you can kind of see what the market thinks is happening and where people are moving their money. All right, so this is the FinViz, and what I wanted to do, I'm going to go to ETFs here, and then I want to look at the different industry ETFs, and we can see how they've been doing lately. All right. Now, I got on ETFs, and this is just stock returns from one day. Let's look at it for like, I don't know, let's look at it for the last 3 months. And what do you see here? So we're just looking at this square right here. Check this out. I mean, there's a lot of bright green on healthcare. Tech is okay. And sometimes, you know, it doesn't always follow the standard formula for the sector rotation. Part of it may be because, like right now, you know, tech and with AI has been going gangbusters. And so it may not follow that the typical, you know, course of the business cycle just because we're in a unique innovation period right now. This red one it's red because if you read the words up there, it says Direction Daily Semiconductor Bear 3X. So what that's saying is it's like a put option or a short. It's betting on the stock prices going down for semiconductor stocks, and it's trying to 3 times that. So you, like, if you bet $1, it gives you like almost like a bet. If you buy $1, it gives you like a $3 bet. And obviously it's lost 50% because semiconductor stocks have gone up on average of around, depending on which one you look at here, here iShares Semiconductors 21%. Okay, so tech is doing well, healthcare is doing well, consumer cyclicals not so well. And so to me, this is starting to look like is that investors have been positioning their portfolios for the peak of the market going down into the trough. That's how I'm reading this. Energy is not so bad. Pretty high returns for energy, oil these days. Financials okay, but I think the big thing I'm seeing here is one, healthcare is just super bright green, and that's kind of a warning sign because healthcare stocks, people really like those. You know, another one we can look at is McDonald's, because McDonald's and Walmart. And so I'm going to go back to the S&P 500. And those stocks tend to do well when people are worried about going into recession. So this is the last 3 months. It's not perfect, but let's see. Walmart minus 1.29. Okay, maybe that's not so great. McDonald's minus 1.5. That's not so great either. So what that says is you have to diversify. You can't just bet on one stock, right? Let's look at the last month and see if things have changed at all. So this is the last 1 month, and we see some of the tech stocks, you know, have gotten a little red. Here's McDonald's, it's up 2% now. And here's Walmart, it's up 1%, which, and if we go down, here's healthcare again over the last month. Again, you know, you see a mix of colors. And this is one of the reasons we say diversify, is because it's hard to pick the winners and the losers within a certain industry. So let's look at the ETFs again, and you see, think of the ETF as the diversified portfolio, right? And so here we see, you know, most of the ETFs are all green, but within those, you know, there's going to be some red within those portfolios, but you know, on the average, the diversified portfolio is up. All right, I'm gonna switch back to presentation here. All right, this is industry life cycle. So this is just what the purpose of understanding this is to think of a mental model to gauge a company that you want to invest in. Are they managing their business appropriately for the industry that they're in? Are they managing their business appropriately for the life cycle that their industry is in? And so let's take a look at some of the different life cycles here. All right, so we got the startup phase. I think that's pretty self-explanatory, right? Companies are just investing. They're probably not making any profits yet. They're focused on developing their product and getting initial customers, right? And so then we have consolidation phase, and that's where, we start seeing winners and losers. And very often the winning companies might buy out the losing companies. And so the companies, they start having fewer and fewer competition. And we enter this phase of more stable growth. Okay. And then the third phase is called maturity. And that's where the companies start, the growth or the industry starts to slow down. And maybe it kind of grows with the kind of similar to the overall economy. And then it could then go into something called a decline. And that's where the industry actually starts going away. Okay, so those are the four phases. And the point here is that if you can identify a company that you're looking at, and you can identify what industry they're in, and you can identify what part of the life cycle that industry is, and there's certain expectations that you could have as an investor about how they should manage their business. And if they don't manage their business appropriate to the part where they are in the life cycle, the stock may not do well because it may not have a good strategy. Let me give you an example. What if you have a company in an industry that's in relative decline, and then they start taking out tons of loans, and they start building new factories, and they said they announced they're gonna increase production 50% in an industry that's shrinking? You can kind of predict what's going to happen. They're going to start losing tons of money soon, right? As soon as all those assets start being depreciated, and then the profits don't come in. Okay, so that's an example there. Maturity, right? Again, you probably don't want to see companies making huge investments because growth is slowing down. In this stable growth period, you would expect companies to start buying up competitors, probably doing a lot more advertising. In this startup phase, you probably wouldn't expect the company to start paying dividends, right? They need all the cash they can get to invest in the product. So that's just an example where if you see companies doing things that don't seem appropriate to where they are in their life cycle, they may not be a good investment.